Hi, my name is Gary Romano. I'm with Civitas Strategies, and I am joined by,
Annie Riley. Hi, everyone. Also here from Civitas Strategies.
and we're here to talk to you about some great funding opportunities that we see a lot of childcare businesses not availing themselves of, as well as families in Georgia. Some of them are new, some of them are existing, and we want to make sure that you know about all of them. If you're a childcare business, whether you're for-profit or nonprofit, these are important. If you're somebody who works with them, like a business coach or a government entity or nonprofit that's supporting childcare providers, this is critical information to know. And I should say also families with young children, because we're going to talk about those as well. So we're going to, just to distract you a little less, we're going to come off camera as we talk about this, and we're going to just dive into it. So you could just focus on the content. So we're going to talk about some of Georgia's House Bill 136 credits. Annie's going to share those with you. Those are exciting new tax credits that the state of Georgia has enacted for the benefit of childcare providers and families, as well as federal credits. And we're also going to talk to you about ways that you could reach out to us if you have questions. So jumping into the content, we want to talk a little bit about what's a credit versus a deduction. I know if you're like me and you get very excited about tax talk, this is something where you say, I know this, right? But some of you may not. And you'll hear me say I always consider tax credits magical. And I'll explain why I do that. Why they're powerful, so powerful for small childcare businesses in particular, as well as some common myths and missed opportunities. Then we're going to start going into talking about some of the specific ones. So let's talk about that difference. A tax deduction reduces the amount of income you're taxed on. A tax credit reduces the actual amount of the tax you own dollar for dollar. So credits are typically more valuable, right? Because if you deduct the amount that is taxed, you're saving whatever tax you would have had against that amount. But a tax credit is like you paid that tax already. So again, that deduction lowers your income, right? So if you have $1,000 deduction, just to keep the numbers easy, um, that's going to save you less than $300 in most cases, which is great. Look, don't get me wrong. I'll take $300. I'm sure you would too, right? But a tax credit lowers the actual tax bill dollar for dollar. So that means $1,000 tax credit saves you $1,000 in taxes. So again, wouldn't say no to $300. I would say yes to 1,000 over 300, and I'm sure you would too. So just, going over it, right? Like between the two of them, that's part of why I say they're magical, right? So, you know, some of the other ways, of course, they're going to help you is number one is lowering that tax bill, right? Or increasing your refund, which is a good thing, right? As you'll see, they can also help you cover key costs like staffing, facility improvements, or benefits. They're designed specially to support you as a small business in particular. And by the way, when we talk about small business, we're talking about 500 or fewer employees. So even some of you multi-site centers there, this still applies to you. This also, by the way, a number of these credits will apply to you even if you're the sole proprietor of your family care business and it's just you. Some are going to be refundable, meaning that they are going to benefit you no matter what. So if you have $1,000 refundable tax credit and you owe $500 in taxes, it not only pays the $500, but then gives you 500 more. It's as if you overpaid the government. Non-refundable will just pay the tax bill. But for most people, these credits that we're talking about, they're going to pay your tax bill. So you're going to make out well. You won't be leaving money on the table. And they're really here to support long-term goals for your family or for your business. And so it's important to think about how this can be a resource, a lever for reaching and realizing some of the long-term goals that you have in your life. So let me talk about some of the common myths and missed opportunities. And I should say, for transparency, I have over the years coached at least thousands of childcare businesses. I've seen more tax returns for childcare businesses than anyone else in the country. So I'm pulling on that. This is not just kind of just saying these are kind of random things, but having met with so many businesses just like yours in Georgia and other states, I can tell you many of them will say I'm too small to qualify, right? But many of these credits we're talking about are specifically for small businesses or for families of any kind, right? So that myth we could set aside. It don't make enough to benefit. Refundable credits, as I mentioned, even if you don't pay a lot in taxes, they're still going to pay you back. Even if it's a non-refundable tax, typically for businesses, that your tax bill is going to exceed that amount. So it's going to be money in your pocket. It's too complicated. Some of these require one or two forms. They're usually very easy to actually do. My tax preparer would tell me. So my apologies to anyone whose loved one is a tax preparer. You know, again, having worked with so many childcare providers, especially on tax issues, the tax industry tends to be a puppy mill. It tends to be something that they're trying to do a volume business, and many times advising you on the things that you may be able to take advantage of slows them down and reduces their profit margin. So they're focused on getting you in and out, as I snap my fingers. So very often your tax preparer isn't telling you not because you don't qualify, but because they feel like that's going to slow them down and they want to just get your return done and in, unfortunately. So let's talk about the opportunities just in Georgia, which are so significant and so exciting, most of which are brand new. And for that, I'm going to hand you over to Annie Riley.
Hi, everyone. Thank you, Gary. I'm very excited to chat with you today about House Bill 136. So, Georgia's House Bill 136, you'll often see written out as HB 136, was signed into law in May of 2025, and it creates three separate tax credit opportunities. I want you to think of these as different tools, each designed for a specific situation. Each credit has its own timeline as well. What makes this really good policy is that these credits address different needs. So families with childcare struggling with childcare costs can get help through the Child Independent Care Credit. Parents with young children who aren't in care yet can still get relief through the Child Tax Credit. And businesses that want to support their employees get rewarded through the employer-sponsored credit. The important thing for providers to understand is that these credits can't be combined with each other, but they can be used strategically depending on a family or business's situation. We can pop to the next slide. Perfect. The first new credit is in addition to the federal child tax credit, which is a maximum credit of $2,200 for 2025. So Georgia's offering their own version of this credit under House Bill 136, and it's called the Georgia Child Tax Credit. This begins in tax year 2026 and offers a $250 credit per child under the age of 6. This credit is intended to help offset the everyday costs of raising young children, regardless of whether that child is in childcare. So even if your child is under the age of 6 and not in a childcare facility or business, you can still qualify. This is a non-refundable credit, which means that it can only reduce the amount of state taxes owed. It will not result in a refund. Only one parent or guardian can claim this credit per child per year, and it must be done through a written agreement or court order if there's shared custody of that child. The second credit in HB 136 is Georgia's version of the Child Independent Care Credit, which applies starting for the 2025 tax year. This credit is now equal to 50% of whatever a family claims on their federal return for child independent care expenses. The maximum eligible expense for the federal credit is $3,000 for one qualifying person and $6,000 for two or more. So, for example, if a family receives a $600 federal credit, they can receive a $300 Georgia credit. Prior to this, the child care tax credit let Georgia taxpayers take a credit of up to 30% of the amount they could get off their federal income tax returns. Again, this is also non-refundable and cannot be carried forward to a future year. The main value here is that it provides direct relief to working families who are already paying for care to work or attend school. And lastly, the final Georgia credit under HB 136 is aimed at businesses and employers who help pay for childcare on behalf of their employees. Employers who have never offered this type of support before, this support being helping to pay for the cost of care, can receive a $1,000 credit per child under the age of 6. However, if they've already previously supported childcare, the amount is $500 per child. In both cases, the businesses must make direct payments of at least $1,000 annually to a licensed childcare facility. This is in addition to wages. It's not in place of wages that you pay to the employee. Employers have to apply through the Georgia Department of Revenue for pre-approval before claiming the credit. There's a total statewide cap of this credit of $20 million per year, and if applications exceed that amount, credits might be prorated. This incentive is to encourage more businesses to begin offering childcare support to sustain those already who do. And Gary, I will pop this back over to you.
Awesome. Thank you so much, Annie. And this is so exciting because just to underline this is not typical. What you just heard from Annie about the state of Georgia is not what is happening in every state. There are very few states who are doing this, only a handful. And they're certainly not, they're typically, if they're doing any of these, they're doing one or another. They're not doing all three. And that's a tremendous opportunity for the families and childcare providers throughout the state. So we want to make sure that if you are a childcare provider, and this could benefit you, that's awesome. If you are working with childcare providers, let them know. And certainly for childcare providers and those who are working with them, letting the families know that these opportunities are out there is absolutely crucial. Now, what we're going to now talk about is some of the federal opportunities that can layer over the Georgia tax credits and provide additional value and funding. And these are opportunities that can support not only care, but staffing, retirement, and other critical functions for your childcare business that you're paying for or may want to pay for, but can't normally afford without the help. So let's start with the employer-supported childcare credit. So this is a credit that is very similar to the one Annie described that Georgia offers. This is at the federal level. It's up to $150,000 per year. And this is for employers who provide either childcare facility or contracted care. So having a contract with a family care provider or center to care for the children of their employees. And it covers 25% of those expenses. It also covers 10% of resource and referral service costs. So if that employer brings in a CCR&R or one of the for-profits like care.com or something to help their employees find care, it covers 10% of those costs as well. Important to note, it has to benefit all employees equitably, right? So a business can't just say, oh, I'm going to have these special benefits just for the top 3 managers or something along those lines. It's got to be something that's broad-based. Now, this was a good credit, but next year, starting in 2026, January 2026, it becomes a great credit. And what's happened is with the passage of HR 1 by Congress and signing into law by the president, this now expands the credit further. So small businesses can now get half their expenses up to $600,000. Larger employers, so those with more than 500 employees, get 40% of what they're spending up to $500,000. There's also what are called intermediaries. So previously, part of the challenge with this was if you're a business and you want to avail yourself of this credit with a childcare business, you had to have a contract that was 1-for-1, right? So if I had a business and I wanted Annie to care for my employees' kids, I would have to have a contract with her. Well, that favored very large businesses, right? Very large childcare providers, because if Annie had multiple sites, she would be more likely to be able to handle the children of my employees. Now you can have intermediaries. So these are organizations, they could be CCR&Rs, nonprofits, for-profits, who will be able to essentially act like an HMO. So on one side of it, they'll have agreements with businesses for that care. On the other side of it, they could have contracts with multiple childcare businesses of all different sizes to help serve those children. So like an HMO, right, your employer and other employers may use the same healthcare company. You then have in-network, if you will, providers, right? You'll have the same thing for the first time. And that's going to provide an incentive for those businesses that may not have the time to have 5 or 6 or 7 or 20 or 30 contracts with childcare businesses. They'll be able to do this through the intermediary. And on the other side of it, for a childcare business where you may say, oh, I only have 1 or 2 slots, that's not huge for an employer. Well, aggregated, right, brought all together by that intermediary, that becomes interesting. So this is something that we're very excited about, that you're likely to hear more about. So if you're a childcare business, know that you may start hearing about these intermediaries popping up, and we want to make sure you know that, you know, what it is and what it's about. And also, of course, you know, employers still can contract directly as well. That doesn't change. So how do you claim the credit? In this case, you use IRS form 8882. It is, I actually heard a tax attorney in another state who I was on a call with say this is the easiest tax form he has ever seen. It is super easy. You want to track construction and contract costs that you have associated with it, referral services and vendors, operational costs, licensing, if you're providing your own facility. But again, very easy to claim the credit, very powerful. Another one we want to talk about is around retirement. And we know that it is often very difficult as a small business to offer the benefits that you want to offer for those people, you know, that are your employees. And those benefits can also be powerful. Yeah, I mean, you want to offer them, but also there's an incentive, right? Because it helps with retention. We know this statistically. And retirement is a really key one. You know, this has become by far, if you look at NAEYC's data, excuse me, that came out a couple of months ago, other organizations, retirement is a key issue for employees and for business owners in the childcare industry. It's actually starting to hit #1 as a concern. And for many childcare businesses, the question is, how do I pay for it? And what amazes me is how many people just don't know about this credit. You can get through the Savers Retirement Credit. So this is for you as an individual. So if you're a sole proprietor, if you're that individual who has your own family care business, it's just you, you can qualify for this. That's 50% of your contribution that comes back as a credit up to $1,000. So in other words, if you can set aside $1,000, you get 500 back. Put in 1,000, get 1,000 back. This does get affected by adjusted gross income and your filing status, you know, depending on whether you're single, head of household, married. But for many providers, especially those sole proprietors, you're going to qualify for this. And this is really good. It's a nice incentive to get your retirement on track, get it going, and get some money for doing it, right? So if you've been thinking about increasing your retirement contributions, this could be a great opportunity to do it. Let me give you a little example of how this works. Monty is a family care business owner, sole proprietor. She made $38,000 this year. She put $2,000 into a simple retirement account, which is a type of retirement account. She saves $546 in self-employment taxes, right? Because that amount that she put into retirement is deductible. So she's already saved the deduction. Remember I said tax credits are better, but we never say no to a deduction, right? Plus, she gets the $1,000 in the credit. That means for her $2,000, it really only lost her $454. Now, again, $454 is $454, but to boost her retirement in that way, what a great value. Secure 2.0 is another one that's around retirement. This one's for employers with employees. And this one is also very exciting. It is one, if you've been thinking about adding retirement for your employees and you've been trying to figure out how to pay for it, this is a great way to get started and get those going. You can get up to $5,000 for planned startup costs. So that's everything from how much it costs for you to engage a company to help you with it if you have a broker, right? It includes meetings with the employees, materials that you may print up for them to explain to them their options, all of those things. Plus up to $1,000 per employee for their contributions, or I'm sorry, for your contributions for the employee, $500 per year if you do automatic enrollment. All that is a box you check when you sign up for retirement, which means that every employee gets auto-enrolled. They could always opt out, but they automatically get enrolled. For that, you get $500. This is all claimed through Form 8881. Let's talk about how exciting this can be. So let's say Estelle has a center. She has 15 employees, and she's decided to start a 401k. She's an LLC. She gets treated as an S corporation, and she's taxed in the 22% bracket. Estelle puts $1,000 for each employee for a total of $15,000. They were auto-enrolled. Between the fees and the cost of her time to set this up, working with her bookkeeper, cost her $25.50. So in total, Estelle has put out $17,550, right? But she saved money in 3 ways. One, she got to deduct this. It's still all deductible, right? So that's $38.61 for her right there. She gets 100% of the admin costs back. She gets the auto enrollment fee of $500,000. She gets $1,000 for every employee. So she's actually saved $21,911. In other words, this has been not only more than free, it's going to take off her tax burden in addition. This is tremendous, right? And what kills me is how few childcare businesses are availing themselves of this. It's a huge one. Similarly, when we think about new employees, right, because we're always worried about hiring and turnover, there are opportunities there. Specifically, there's a federal tax credit just for employers who hire individuals from certain groups that typically, historically, have faced barriers to employment. And this reduces your tax bill dollar for dollar, right? This is a credit. And the idea is it's incentivizing you for something you're probably already doing, hiring veterans, SNAP recipients, and others. So for many childcare businesses, this becomes a no-brainer because they're doing it already. And who qualifies for this? It's somebody who is a veteran, receiving food stamps, SNAP, if you will, those on temporary assistance for needy families, if they've been unemployed for more than 27 weeks, individuals with disabilities, SSI recipients, so Social Security recipients, residents of certain high unemployment areas, and youth hired for summer jobs in designated opportunity zones. So all of these folks, many of whom you may be hiring anyway, would qualify. So the amount does differ depending on the group, but it's up to $1,200 to $9,600 per eligible employee. Think about that for a minute. You're going to hire them anyway. Wouldn't it be great to get some money for what you're doing anyway? The amount does depend on the target group, how many hours they're working. And in some, by the way, some of these go for 2 years. So in other words, it could be 2 years of getting benefit for hiring them just once, right? You want to give them at least 120 hours of employment a year. There's no limit on the number of employees you can claim. So the more you hire from these groups, more qualified people you hire, the more credits you get, which is just great. So if we look at some of these groups, right, and I won't read this item for item, but you can get an idea of, in the case of most of the targeted groups, you consider 6,000 wages, 40% of them would be available for the credit. What you end up with is $2,400 max credit. Still, that's good, right? If you're going to do a hire, if you got 2,400, that'd be great. Long-term TANF recipients, and I was talking with a provider a few months ago in another state, and this was a large number of the people they were hiring, and they had no idea that they could not only get 1 year, but 2 years of support for hiring them. So if they stay for 2 years, you're getting that much more in credits. And again, so you can see veterans are included, disabled veterans, others. This is a great opportunity to support people in your community who need jobs and support your business. So if we take, for example, Alex, a qualified SNAP recipient, $15 an hour for full-time position, right? So we're talking about $31,200 annually for her wages. In this case, right, she's getting the credit is for 40% of the first $6,000 in wages, assuming she's going to work 400 hours, which she is. That means that when you get down to it, she's making 2,400. So yes, for a hire that this business may have made anyway, they can now get $2,400 back. Every employee who qualifies. Right? Another example, long-term TANF recipient, again, making the same amount of money. This is not a grand salary, right? They're not making $500,000 a year, $15 an hour. She's making $31,200 annually. Assuming she stays employed for those 2 years, right? You're getting $4,000 year one, $5,000 years two. That's $9,000 back for this hire. That's amazing, right? I mean, think about that. That's like getting a 15% discount on their salary. That will tremendously help your bottom line. And especially if you have more than one person who is qualifying for it. So again, as you think about the calculation, think about whether they're full-time or part-time, and of course, these other different variables that we've discussed are all critical, right? And again, the form is really quite simple. One of the catches you do want to think about is that you have to submit forms within the first 28 days of the employee's start date. So in other words, essentially you have like the first month to do it. There's no exceptions. Late submissions are automatically rejected. They just won't take them. So what you want to do is begin the paperwork as part of your onboarding process. Ask them about their membership in these groups. Ask them if they fit. So what you want to do is, again, identify those employees within the first 28 days. Check if they meet that criteria. You gather your wage and hours information, right? Like that they've been working on it. This will help you estimate your potential credit. And then you complete IRS Form 8850 and ETA Form 9061. These are online. They're done online by each state. In this case, the Georgia DOL portal within 28 days of hire, you're going to want to fill it out. These forms are super simple. They really are. I'm not just saying that to pull you in. They are very simple forms. So definitely take a look. We have that link at the bottom if you want to pursue this. Definitely one to think about. We also have some other resources if you want, where you can go to our website free of charge. We have a calculator that will help you think about those things, help you determine eligibility, and identify qualifying employee categories. So if you want to learn more about this one, free, go to our website, get more information. So, as you think about these tax credits, right? If you are a provider, great, you're hearing this, right? What I want to make sure is that you don't need to be a tax expert if you're a provider, but if you're somebody who's advising them, you're a business coach or an intermediary working with them, you don't need to be a tax expert to talk about these. These are far less complicated than people think they do. Remember that myth, right? Early on, these are too complicated. I'm not the right size. You are. The problem is what we call information asymmetry. On the one side, you have the information that these businesses need. On the other side is the business. And unfortunately, most of the time, unless it's a larger business with a higher profit, they're not getting the attention and support they deserve. And they never hear about this information. So we encourage you to be part of the solution. Encourage them to talk to a business coach, to ask their tax preparer about these, to keep records, right? And to be able and make sure that they submit these forms on time. Family leave. So, when you have paid family and medical leave, it can be very expensive. Definitely understand that. A lot of times, what the minimum is, we want as employers to provide more than that. And there's actually a credit, 45S, that covers 12.5 to 25% of wages during qualified leave. And this is available up to 12 weeks per employee per year. And even if you're not covered by family medical leave, right? You may say to me, Gary, I got 5 employees. I'm not subject to family medical leave. I don't have to do it. That's okay. You can still qualify for this credit by doing it, right? You have to have a written policy with at least 2 weeks of leave for regular full-time employees. And during that leave, half of the regular wages need to be paid. There you go. That's it, right? So this is not about like you have to have 100 weeks of leave, paid at 100%, right? What it's saying is at least 2 weeks, half of that time paid in regular wages. Employee has to have worked with you for at least a year, work below the IRS highly compensated threshold, which is really quite high. What it does also mean is that you can't be the business owner. So unfortunately, if you yourself want to take this leave as the owner, you can't do that. You're automatically considered highly compensated. You can work full-time or part-time as long as you meet the other criteria. You've got to be leaving for very specific reasons. Birth and bonding with a child. That's one we see a lot in the childcare industry, right? There's a lot of young women in particular who are critical to the workforce, and many of them need that time to be with new babies. Adoption or foster care placement, caring for a spouse, child, or parent with a serious health condition. Employees' own serious health condition, right? If they need a little bit extra time because they're really ill, military family leave or caregiver leave as well. So these are things that we're seeing on both ends of that spectrum. So with younger employees, we're seeing some of these kind of start of family things that come up. For older employees, caring for their parents or having health issues themselves, this can be another way to offer some time for them to be with their families, to get their health in order, to bond with their children, and do it in a way that's not going to cost you entirely. It's going to get you a little bit of money back to ease the cost of doing that for them. Healthcare, another area where we don't hear about the credits very often. There is actually a healthcare credit, right? That is just for small businesses to help you cover the cost of healthcare for your employees. It covers up to 50% of premiums for small for-profit businesses. And this is up to 35% for tax-exempt, i.e. nonprofit employers. Credits available for coverage for those plans that you can get through the SHOP marketplace, which is the federally approved state marketplace for these, right? Each state has their own. They are specific small business plans, right? To qualify, you have to have fewer than 25 full-time employees. So remember, we were talking small business before. For most of these is 500 or under. This is much smaller. The average wages have to be under 62,000 per year. And you have to pay at least 50% of the premium for the employee. Insurance, again, must be purchased through that SHOP marketplace. How do you claim this? Form 8941, right? It's going to go on your income tax return. You can do this for 2 years. It does not apply to credit to premiums paid for business owners yourselves. That actually comes off under a different deduction on your taxes. So certainly, if you want more information on that, we'll give you some ways that you could reach out. We can certainly give you some information on that. But if you're the business owner, this doesn't apply to you, but for your employees, it's a great opportunity. Speaking of which, if you have questions, if it's on those Georgia tax credits, we're asking you to use this email, taxcredits.inquiries@dor.georgia.gov. That's the Department of Revenue. If you have questions about the Thriving Childcare Business Academy, this is a statewide program that DeKalb has invested in to help childcare businesses thrive, to give them the knowledge, broach that information asymmetry I talked about, give them the knowledge they need to be thriving. If you have questions that we can answer there, if you want to learn more about the program, if you want to hear more about the program to share with the providers you're working with, thriving@dekalb.ga.gov is the way to go. So on that note, we have reached the end of our presentation. Certainly, we've enjoyed our time with you. We're glad you've been able to stick out with this. We do think these are tremendous opportunities. Don't hesitate with those questions. We always look forward to getting them, and we wish you well.
Bye, everyone.